Hello everybody, welcome to another episode of Erickson TV, courtesy with Lauren. Hello Lauren.
Hey Curtis, hey everybody.
I understand that you have something to share with us.
Oh yeah, so I'm not sure how recent this is, but sometime somewhat recently, Vanguard did a study and they attempted to figure out if anything predicts stock returns.
Okay.
Does anything forecast stock returns? So they did this study and they lined up a bunch of factors that people often believe predict stock returns. So for instance, they looked at corporate profitability,
okay,
economic growth, the price of stocks relative to profits, dividend yield, what was called the Fed model that people used to use a long time ago, earnings growth, all kinds of different things.
So basically every tool that active managers claim.
Right, yeah. Yes,
okay.
Everything. So they also used rainfall.
Rainfall. Okay.
Right, yeah. So they threw one factor in there that obviously has nothing to do with stock returns, just to sort of see what would happen.
Do they do like the presidential elections?
No, although I think they could have done that.
Okay.
I think that might be in here somewhere. No, they didn't do the presidential elections.
Okay.
But they looked at these factors over 1 year and then over 10 years.
Okay.
Over 1 year, absolutely nothing had any predictive value whatsoever.
Okay.
Almost everything had it literally had a zero correlation. And they were looking at what's called R squared, which just means that it had no correlation, either positive or negative.
Okay.
It just didn't matter. But they also looked at 10-year real returns, and rainfall had a very, very tiny 0.06 correlation with 10-year stock returns, which just sort of proves that even a completely random factor will have some sort of correlation. But even over 10 years, I thought it was interesting the things that still had absolutely zero correlation with stock returns. So it was an even worse predictor than rainfall. Okay, economic growth, no predictability whatsoever,
wow,
not even over 10 years. Corporate profit margins, even over 10 years, no predictability
So I
whatsoever.
thought that would have some correlation.
So you would think at least over 10 years that there would just be something there. Absolutely nothing there. Trailing 1 year stock returns, anything just sort of looks at past history, had no predictability, not over 10 years and not over 1 year. Over 10 years, the only thing that had any predictability that might be useful to an investor was the price compared to the profits.
Okay.
So the profits themselves didn't matter, but the price that you paid for a stock, given its profits, did matter. But of course, over 1 year, it had no predictability at all.
Right.
But over 10 years, and this is really pretty uncontroversial. Of course, over some time frame, the price that you pay for an investment has to matter. In fact, that's kind of the foundation of finance. It's always based on price.
Right.
And so there are a lot of different ways that you can deal with this. I'm pretty happy to mention that here at Erickson Wealth Tax Management, we use one of the most effective methods of dealing with the fact that price does matter in the long run, and that is we rebalance.
Right.
So when prices go up, we sell a little bit of whatever went up, and when prices go down or are low compared to other things, we buy a little bit more.
Yeah, and in this episode, that's one thing we can't control by rebalancing.
That's absolutely something that we can control, and it controls for just about the only factor that really seems to matter even in the long run.
Okay. Thanks, Lauren, for that. That was very interesting. Thank you. We'll see you next time on Erickson TV. Bye now.
See you next time.